Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, all. We will get going here in just a minute, so we'll let some folks come into the spaces, and we'll rock and roll. As always, if you care to jump up to speak or share, ask any comments, feel free to raise your hand or jump up to the platform. But again, just give some folks a minute or two to join, and we'll rock and roll. All right, so welcome everybody. Thanks for joining on another session of the Weekly Notebook Review. If you're new to the spaces, this is an opportunity where we review basically our weekend work midweek. Normally these are on Wednesdays. Today it's on a Thursday afternoon. But this is where we kind of run through the notebook, things that are jumping out at us in terms of new signals on the page, things that we're paying attention to, and trying to really adjust that positioning as we head into, in this case, Friday. And then next week, next month, next quarter, we are about halfway through the last month of the quarter. For those that do year-to-date work, that year-to-date is all done, and that year-to-date will reset in a few weeks. But for those like, most at Hedgeye that are looking at more of the cycle-to-date, we are nowhere near the end of the cycle in our humble opinion, and that is certainly what the nowcast model. If you're not familiar with that is our GIP and nowcast estimates. Those kind of go hand in hand, and the growth, inflation, and policy model is certainly looking for decelerating growth as we head into Q2 of 24, and then some slight acceleration back up to just north of 100 basis points of positive growth in Q3 of 24. So it's going to be an interesting kind of start to the year in the the first half of 2024. But I think from a cycle to date standpoint, again, from a cycle standpoint, the peak in the S&P was January 3rd of 2022. So almost 2 years ago now. It's kind of funny. Almost 2 years ago now. And for those in the NASDAQ, it was November, I believe the date was November 8th of 2021. So those are really the kind of the full cycle that we're looking at from a U.S. market standpoint, and really what you should be kind of paying attention to in regards to where we come from, not only from, the last 12 months in terms of year to date, but also, where we come from peak to trough. And right now we're certainly anticipating or positioning the portfolio, and we've been talking a lot about the monthly quad fours that are on the horizon in January and February. But what I will say, as I've done some more work and deeper work with the very wonderful David Salem, is, if you kind of dive into the numbers more and a little bit less on sort of just the quad number itself in terms of a 4, which is a decelerating of both inflation and growth, what you'll notice is that growth number in Q1, right now the estimate is 158 basis points. So let's just round it off to 1.5. In Q4, we're looking at about a 2.5 number. Then now that's down from a 300 basis points or 3% in Q3 of 23. So you're kind of looking at basically a 50 basis point deceleration here in Q4, and about another 50 basis point and then about 100 basis point deceleration in Q1. And really that trough kind of finding that low in Q2 of 65 basis points. So I think it's going to be very interesting as we start the year. Now, flows will be flows, and the gamma flip line, all that kind of stuff. Negative, positive, gamma. We need to be paying attention to all of that. But if we look at, dive a little bit beyond kind of the signal that's on the page right now, and we are still bullish trend on the NASDAQ. We are bullish trend on the XLK. So tech is still working on the page. I think it's going to be very interesting to see what the earnings picture and certainly the guidance for 2024 will look like when, they are, although a decelerating, growth number in Q4 here of 250 basis points from 300 in Q3 on a Q over Q base, Q over Q basis. If you go back to a year ago, you're looking at a plus 65 in Q4 2022. So is it possible that some of those numbers will look a little bit rosier on certainly a year over year basis? Very possible, right? So I think just managing this first half of the year is going to be very, very important. And I think staying very nimble will be crucial. Following the signals will be even more important. And having some humility in regards to the unknown and not knowing, and just sort of doing your best to make the best moves for the right, for the quote unquote right reasons. That's really a big point, and I think something that we all need to be focused on here as we round out the end of the year and try to really start 2024 off on a great footing. In terms of things that are popping off the page, there are a few. Certainly volatility and what it has been doing as of late, and what it is possible it does as we move out over the end of the year. If you look at the VIX, and my good friend, I see him listening in here on the call, Mr. Thousandaire FX, he sent me a little picture, and it was really a look back in regards to the higher pricing from October, and how many more days is that going to take for that pricing to sort of start to fall out of the look back window? I think that's a really, really important call out. And so hat tip and thanks to Chris for sending that over to me today. It was funny. I always love when Jedis like him and other folks within the community kind of send me notes. I had a good friend of mine as well from California. He was sending me some commentary last night in regards to, hey, have you seen this? Have you seen that? And luckily, my answer was yes. But the fun part is, when you're literally, I was looking at the exact same thing as Chris was sending it over to me. So if you think about kind of like the look back window on pricing, we had a good chunk of sort of basically most of October, certainly going into, what was the peak there? It was, the peak was, excuse me, let me just pull it up. Peak was October 20th, but we still had some pretty elevated pricing going into the 27th of October, and kind of, October 30th as well was up north of 20. So a lot of that pricing, say, called north of 17, which really was for most of the month of October, north of 16 at least, 16.21. That's going to start to follow the look back window, but it's going to take about, I think I calculated about 15 days. So it's about 3 weeks. So there's still possible that you're going to have kind of like on a trade duration, volatility that is going to, it's going to take some time for those prices to fall out of look back window and to kind of try to reset at these levels here that we have right now, which is really under 14. We had a spike of kind of around that a few days ago, but we've really been sort of trading in this sort of 12.5 to 13.5 band for about, call it 10 days or so, which is a very, obviously a very low level of volatility. Certainly over the course of the last year, this is sort of some of the lowest volatility that we've seen, and it's very reflective of the positive gamma that we have been in for the last few weeks. We did close, and I called that out this morning. We closed in negative gamma territory last night, yesterday, but we opened, basically we immediately opened back up in positive gamma environment. So again, just these things, gamma, the flip line, is just another tool in the toolbox. You need to know where it is, because things can start to get kind of escalate at those levels when again, dealers have to come into the market and they're selling weakness versus as well as buying strength. You just get higher levels of volatility typically in those environments versus a positive gamma environment where volatility gets suppressed. And you've seen that really as of late, the last few days. And we had a plus 80 basis point day to day on the S&P 500. But, up until then, it's really been, I think the biggest move was a plus 40 basis point day. And even a plus 80 basis point day isn't exactly a, crazy vol day in terms of, big spikes, 2% moves, et cetera, et cetera. But yeah, again, just something to be calling out here. I think it's very important to not, going beyond just the VIX and looking at the VIXen. It closed just north of 17 today. Again, that's basically the lowest vol we've seen over the last few weeks on the VIXen, certainly all year. And if you pull back on a 5-year chart, it goes all the way back to pre-COVID in 2022 that you had a 17 handle on the VIX. And then conversely, you also got, the move, which moved higher again today, up about a little under 4%, up to rounded up to 130. So, for those that have gotten long, maybe the longer end of the curve or some fixed income exposures here in the U.S., this is a time where, with elevated vol, you should be naturally reducing your position with elevated volatility. If you kind of think about it in terms of buckets or maybe buckets of volatility or what have you, you kind of have tiers, right? So if with the move at 110, maybe your max exposure is taking a round number of 5%. Well, at 120, that number should probably decrease by, say, 50 basis points, maybe 100, depending on your risk profile and your risk parameters. But again, with moves of volatility to the upside or the downside, that does allow your position sizing to get larger or should invoke a kind of smaller sizing as well. So again, this is a perfect example here within fixed income. Would be something like a PFIX. It has a much higher, call it 30-day, if you just look at the 30-day realized volatility measure versus something like an SHY or even SHY if you wanted to pair it off with an HYG. These are things that actually have a kind of similar profile in terms of their vol construct at the moment. But again, these are things that you should be paying attention to, right? Volatility. Again, just to call out my buddy Chris, he tweeted out about GBZ a few days ago in terms of post the spike higher in gold volatility, while gold kind of fell the other day. It's these kind of components where with gold vol rising, your overall total max exposure should be, or position sizing should be naturally reducing. So again, just kind of want to call these things out from a volatility standpoint. I think generally speaking, volatility has been kind of pretty benign, obviously on a week over week basis. Month over month basis. Certainly, most numbers are down. The move is up, about kind of the only one along with FX vol, and GVZ. So on a month over month basis, but on a week over week basis, if you're kind of looking at that, the move is up over 1,000 basis points. And FX vol is up 25 basis points. So that's a pretty big move for FX vol in general. So again, just kind of pay attention to these volatility measures, pay attention to price action on a day over day, week over week, 1 month, 3 months, 6 months, 1 year, however out, you can go out further as well to 3 years, even paying attention to kind of how things are moving on the weekend and tracking that kind of momentum. The other thing to call out, obviously, I think, it's pretty, it's kind of staring all of us in the face. Obviously, the big boys, the Elite Eight, as I affectionately like to call them, they rebounded today, right? So, I mean, Google is up over 5.3%. Meta is up almost 3%. Amazon's up over 1.5%. Apple's up 1%. So, a lot of these components that there's a big shift in terms of coming into the week. You saw some of those Elite Eight starting to break down. You got confirmation of that really this morning, where 4 out of the 8 went bearish trend. Netflix is neutral, and Microsoft, Apple, and Amazon maintained the bullish trend exposures. But certainly, kind of on a week over week price momentum standpoint, started to, I guess Apple was positive, but coming into the day, but everything else had negative kind of price week over week momentum. So these are things to be obviously be paying attention to. It'll be, some of these are kind of basically right on the trend line or the kind of the flip line for their trend, bullish, bearish, signaling from a signal standpoint. So just be paying attention to those. I mean, if some of these Elite Eight continue to roll over or lack sort of pricing power, kind of price action to the upside, which is really what they need to regain those bullish trends. It could kind of start to be a signal of things rolling over, and kind of you may end up getting the rest of the market to kind of follow in suit. So again, if not though, and to be kind of I guess, contrarian to that, if those do start to pick up, price momentum to the upside, then it is very possible that we get sort of a year-end, call it a year-end rally, or sort of a confirmation of more bullish price action within certainly the Elite Eight. And maybe it's a breadth thing, maybe it's not. Is that enough to kind of keep S&P and the Qs and the NASDAQ moving higher? Who knows? But certainly the signal is going to help guide us through that decision-making process. I did briefly talk about yields on the within the MOVE index, but realistically, obviously, we've got a big kind of a relatively important print tomorrow from an economic data standpoint. That's likely going to have a reasonable impact on what kind of the market will start to price in from a Fed funds futures rate in regards to potential future cuts or raises. And then also, what does it going to look like for the 30, 10 year, 2 year, the yield curve, et cetera, et cetera. Again, this is not really a forum where we speculate in terms of the anticipation of that number. But what we do is we react to what the market does. So I think it's going to be very interesting to see how that transpires. Right now, the 10-year Treasury, the yield, is just above basically the low end of risk range, which was, as of this morning, 4.10. It closed around 4.15. Basically, I think yesterday it closed pretty much spot on that number. Yeah, 4.106 is where it closed yesterday. So we bounced right off the low end of the risk range, kind of to be expected. Keith uses that terminology all the time. So will it go up to the top end of the risk range, which is 4.51? Who knows, right? But, we have been, or Keith has been, certainly talking about the tail support of about basically 4% to just to round it off as a level to be paying attention to. And if the 10-year starts to break down from there, then hey, we might really truly have a new regime of kind of within the bond market. But could we also just trade in a band between say 4 and the low end of the risk range, top of the risk range, call it 4 to 4.5 on the 10-year? Absolutely. Could it be from 4 to 5? 100%. Could it be 4 to 6? Who knows, right? So I think it's just going to be really important to kind of keep track of that, watch those signals, and obviously, from an inflation standpoint, just to reiterate that fact in regards to what we're kind of looking for from inflation within the U.S. is a pretty steady level of inflation of around 3.25%. So that's something that's going to be very interesting to watch. Obviously, if we get continued weakness in oil pricing, that's the second largest component of CPI. So that could bring down kind of our estimates here to a decelerating inflationary environment. But for right now, we're certainly now casting a relatively flat, although higher for longer environment, and certainly not the 2% that the Fed and other central banks are targeting. So again, just going to be very interesting to see kind of how that plays out in 2024 in conjunction with the rate change slowing environment of GDP. The other call out too, and again, I've had the pleasure of working with David this week in regards to assessing some of the appraisals that he'll be delivering tomorrow in CIO Corner. But the big, I think one other big kind of component, and something that we've seen Keith certainly adding to his long-only account in the Munger family office, is that EM exposure. EM does look pretty enticing at the moment, and we're certainly seeing components like EM, EWM, right? EWM, you can EWZ. EWZ is bullish, trade trend and tail. Something like an EMB, just to kind of keep on that fixed income space, also bullish trade trend and tail. So very much kind of some interesting exposures there. India is one that Keith has been pounding, sort of reiterating the long exposure, certainly on Twitter and elsewhere. And that is, again, bullish trade trend and tail. And although quad 4s and 3s are kind of on the page inside of India, you're looking at very robust numbers of GDP growth, even though they are decelerating from basically 7.5 to call it 5.5 as you go out in time and space. So still very robust growth in India, and something that we are kind of anticipating to be able to have in the portfolio for quite some time, in that outlook out to, say, Q3 or September 30th of 2024. So just kind of wanted to call out EM and the potential pivot here in regards to a flow of capital moving towards EM that we haven't seen for many, many years. David reminded me earlier this week that it basically goes all the way back to 2006, 2007. Last time you really had, EM in favor, quote unquote, within for capital allocators on a global scale. So will that have legs? Who knows? I think it's just going to be very interesting, and the signal will absolutely continue to help guide us in that process. Lastly, and then I'll get off my soliloquy, the quad 4 exposures that are picking up signal strength is certainly something that needs to be called out. And I know we haven't had this notebook review for a few weeks, so I do apologize for that. Just between travel and Thanksgiving, it's just been a little hectic within the McGroarty household, and in particular for me, myself. But the things like healthcare, whether it be XLV or Pink or even consumer staples, that consumer staples is now neutral trend on the page. Keith talked about it on the call this morning with Daniel. But these sort of quad 4, generally more quote unquote typical quad 4 exposures are picking up signal strength and are maintaining that signal strength. And I'll just reiterate XLV, even GDX, XLP is another one, right? So, these, and XLU, how could I forget the Utes themselves? So I think just that kind of component in and of itself, with bonds starting to work, but will they kind of continue to work? Who knows? But those kind of like more traditional quad 4 exposures, the fact that they are working is an interesting signal and something to be paying attention to. And we'll see what kind of transpires as we head into what we think is certainly going to turn into decelerating growth environments in Q1 and Q2 of 2024. So with that, I'll take a pause, have a little water. If anybody wants to jump up, share their insights, their thoughts, questions. This is an open forum. This is for Hedgeye Nation. It's way more fun when I get to talk with Hedgeye Nation. And I know I said I was just going to take a pause, but I wanted to also give a huge shout out to the 50 or so folks that joined us live and in person last Wednesday night in Toronto. It was fantastic to meet all of you, to put names and faces, to see old friends. So Wasim, John, it was great to see you guys, and great to just kind of be together in a room full of wonderful people, like-minded people. And we had some great conversations, great questions. So hopefully we'll have another one of those sessions type of things tonight. All right, not everybody jump up at once. Hard to answer questions when I don't receive any questions. All right, well, here we go. So look at my boy. Mr. Thousandaire FX, welcome to the program.
Hey, buddy.
I know you're a long-time listener, first-time caller.
Yeah, it's been a while. Can you hear me? I had to re-download everything.
Yeah, I know. Yeah. We can hear you loud and clear. Thank you. How you doing, man? Yeah. How's I know the weather's been a little shit over in the UK.
The weather has been terrible, yeah. Yeah, it's been pretty bad. But we're getting through.
Yeah. Good stuff. Well, I don't know if you saw, but Keith did add the pound today. The old British pound sterling.
Yeah. It's perked up a bit on some dollar weakness, and everything was going on with the yen today. But yeah, it was funny, like on using the futures. So if you use 6J, which is the yen futures contract.
Yep.
Like people were starting to call out that today's move in the yen was like a 6 sigma move or whatever. But if you follow if you're on TradingView, if you follow the price of 6J is basically exactly where it was last November. But also then as well, you'll see if you just go straight across, straight to the left, there was a couple of days in November that were also as big as today as well.
Right.
But they were like 2 or 3 days back to back with massive moves. So, yeah. And there's some conspiracy theorist out there said big moves in FX normally mean some kind of intervention, but who knows?
Huh. Interesting.
Only a central bank can move a market as big as the FX market.
It's just that's true. It's true.
I know you're a BOJ watcher now.
I am.
Yeah.
I have a whole Substack on it, everything like that. It's how I spend all my free time. No, not at all. But but yeah, that was a joke for everybody listening in. I don't know how this is sound, but yeah. But the end. I mean, it's certainly. I mean, that's sort of the FX was definitely an area that I forgot to cover, but it's been over the last 3 weeks. I mean, you've seen the dollar move to neutral, euro go maintain its bearish trend, but the USD JPY, aka the yen, as you mentioned, has moved to bullish trend, and the pound's bullish trend, and the Canadian dollar this week moved to neutral. So a lot of you could say it's maybe US dollar weakness, because that is we're quoting all of those in USD. But you're also, as I kind of alluded to a few minutes ago, that FX vol, it has moved up 25 basis points in the last week. So big move there, big move in FX vol, and you're kind of seeing some interesting price action and trend changes within the various like crosses.
Yeah.
Or any of the, I know you track some not wonky ones, but certainly I'd call them I guess high beta or high vol unique crosses. Any of those sticking out in your mind? I think the Aussie dollar's been looking pretty good.
Yeah, the Aussie dollar's pretty strong, but some of the wonky ones, like the Aussie against the South African rand has had a big move. The South African rand as a whole has just had a bit of a rip. So, yeah, not very blunt. I quite looking at, for some reason, I quite looking at Sweden, but that's getting yeah. No, it's just, it's so interesting. Like, it's almost like as soon as the equity market starts perking up, it's like all these things don't really exist anymore. But then when the S&P 500 is down, everyone's obviously paying attention. Like, oh, it's because of rates, and oh, it's because of the dollar, and oh, it's because of this, and all kinds of narratives are coming out everywhere. But obviously, now that the stock market's up, nobody cares about that anymore. Because they don't. It's amazing because they don't have to find an excuse for something.
Exactly. Yeah. Yeah. It's interesting too. I mean, just kind of going off, and yeah, it's a good point. And I think from a signal strike standpoint too, and Keith delivers this to institutional clients on Sunday, so I know you haven't seen it, but I talked about it on the healthcare show with Tom Tobin today, and there's like 5 healthcare stocks inside of the S&P that are showing up on inside the top 29 signal strike, right? And so it is interesting because you are right? I mean, in terms of when things are up, the equity market's up, then who knows, but then at the same time there are components inside of, say, the S&P or NASDAQ, what have you, that there's a rotation-ish trade there that happens, and there are things that still work even in down tapes. And again, I'm making that comment because it's not just equities, it also expands to there's potential rates, fixed income exposure to have on the book, there's other exposure to have on within the FX market, right? So it is very handy to be able to go anywhere.
Yeah, I think moving forward, this is obviously we'll see over time whether that's the case. I think being able to actually genuinely go anywhere will be I know lots of people on this call, like, it's even when most people say go anywhere, they really just mean kind of like a spicy US ETF, right? Ooh, that's a bit spicy. But I think moving forward, potentially actually genuinely going anywhere, like actually having an FX account and actually being able to trade currencies rather than just US ETFs, maybe might be something. Actually going and looking at equities in other places could be something that we have to do and be much more, possibly even more short term to not even that. Obviously the goal is to try and maximize returns, but even just to protect yourself, you need to, especially if you have to be allocated because you're running other people's money, you may have to start to look for other places where you can make sure that your cash is always at work.
Yeah, and the UK. So again, I'll go back to David Salem and my work this week. But the UK has popped up on our radar in terms of like the appraisal process, and it puts out. Let me just make sure I'm not misquoting this, but from a yield standpoint, it puts out, I think, like a basically 3.5% yield, and that's an annualized yield, right? But it's one of the more robust ones out there in terms of global and non-US stocks. Australia's a little better at 3.9. And Brazil, oddly enough, has an 8% yield. So on an annualized basis, but you're absolutely correct, right? And again, that's just the ETF, WU, EWC, and EWA. Let alone if you go and you go in and you hunt inside of there for, say, some UK utility companies or whatever it might be, right? In regards to trying to pick some of the cream of the crops, the ones with the best signal strength, you can really put together a pretty sexy portfolio that can kind of mimic those ETFs, but with ideally with better signal strength companies on inside of them.
Yeah, for sure.
Yeah. Perfect. I had another thought that I was going to share. Oh, in terms of the FX accounts, if this is not an endorsement, and I'm not sponsored, not a paid partnership with IG, but Chris introduced me to IG. I know many folks within Hedgeye Nation use IG.com. So that's what is that? Is that India? That's not right. Is that right? Is that it's India? What's the G one again?
You should know that.
Gamma. I should know this. Is it George? No. Golf. Oh, I should know that one. IndiaGolf.com. I had a paper trading account for a very long time. I would highly recommend you start there because it is a completely different ballpark in regards to trading pips. And it's really fun to say that, pips. I trade pips. Would you like 25 pips of the US Euro USD? Yes, please. Anyway, but yeah, that's actually a pretty big trade. I'm not that big time. But yeah, that's a great place to start from an FX standpoint. Go do that. It is fun. It's fun to kind of get, wet your whistle. We certainly talked to, I think I see George Syracuse out there. He is, and Blair Applegate. They've talked on Weekly Notebook Review about going directly to Treasury Direct, right? .com. You can buy T-bills, Treasury notes directly from Treasury Direct. So a lot of different ways of having your own direct access to not only Treasury notes and T-bills, but also to FX and currencies, et cetera, et cetera. X2, what a pleasure to have you on.
I guess my microphone was off. What's going on?
I'm good, man. How are you?
Not too bad. Not too bad. I was jumping up to tell you that it's golf.
I love it. Sorry about that, guys. I really should know that.
How do you not know?
And I know. I got to print it off. John Weeks is like literally probably dying and laughing so hard. He even sent me a cheat sheet. I just need to print it off. I got to go find it and print it off again. But yeah, golf. Speaking of FX, I know you love to trade the euro dollar. Where did you start, out of curiosity? Did you start on IG? I mean, I know you're a big timer, so you probably
Yeah,
started.
I am not a big timer. Where did I there were definitely some multiple iterations. I think I started with Thinkorswim.
Yeah.
What else did I use? What's the other one? I have to look it up. I don't remember now. But yeah, there are a bunch of them. IG is good. It's very user friendly. So yeah, I'd recommend it.
Yeah, it's good. It's good. Yeah, luckily you never had to send like a telegram, right? Next year.
A telegram? When I was trading in like use carrier pigeon to get asked.
Doing yeah. Anyway, anything else on your mind, man? Anything else? What's going on in the family office?
Not too much. Trying to figure out. I actually had a call with an RIA today, and he was kind of complaining about the situation. Trying to go up against the the measuring your performance against what happened this year. It's a little scary out there.
Yeah. I mean,
unless you had the right stocks, so the 7 stocks, you underperformed. So.
Yeah. These numbers are from this morning because I haven't had a chance to do my evening work yet. But yeah, I mean, the S&P's up, almost 19% year to date, and Nasdaq's up 36% year to date. So obviously, those both went higher today. So those numbers are going to only look better. But yeah, I mean, those are the year to date. But again, from cycle highs, right? You're still down. I'll do the math here quickly. If you guys, where are we? Where's the high? I'll go find it. You guys talk amongst yourself for a second.
Chris, how you doing, man?
I'm good. Yeah, I'm good.
It's quite a late there, isn't it? Over the pond.
Well, I think we've already done the weather. That's a very British thing to talk about. So we're we can't do that.
All right.
What about that crypto though?
Talking about utilities, some high quality utilities in crypto land.
Yeah. Let's make it up. Trying to build up, like obviously, like you have in the equity market where everything's split by like GICS levels. So you have the sectors. So you have energy, and then the next level down is the GICS level 2, which will be like exploration or refiners or something. So the subsectors or sub-industries, I think they're called. I was trying to do that for crypto rather than just having one big massive blob of like 50 or 100 different tickers. I wanted to try and put them into sectors. And one of the ones that I could find was, it was split by, I don't know what it was. Currencies, utilities, platforms, culture. There's like some NFT type stuff in there. Something else, and then I called whatever was left over, just the leftover bucket. But yeah, it was fun. Yeah, obviously making a terrible joke saying that everyone that said a recession was coming, when they told you to buy safety, I don't think they meant buying crypto utility tokens. Yeah.
Yes.
Some of them are up like 300%.
How's my neighbor Sally doing?
My neighbor Sally, yeah, that's a good one.
Yeah. But yeah, S&P's down about 5%, and Nasdaq down about 10 from the peaks there in 21 and 22. Just get back to that. Cool. All right. Well, everybody, by all means, jump up, asking questions. Covered a lot already today. Let's see here. From a setup standpoint, I mean, there's a signal in or certainly something to be. We've got 13 shorts on in RTAs versus 1 long in DraftKings. So that's certainly something to be paying attention to. And then also from a long only standpoint, the Portfolio Solutions product or Keys Daily long only, we've got 29 exposures there. So I think it's certainly, we got lots of longs to be. We added kind of platinum this week, GDX, physical silver actually was one that we added this week, which was interesting. Took down, NUP, or the dollar's kind of all the way down at the bottom. Ethereum and Bitcoin are in there as well, which have been great additions and continue to perform quite well this week. So Bitcoin's been a good one.
Hey, Robert, one more call out. The yen hit a lower low today.
It did.
Through the lower end of the risk range.
It did. Yeah, and the JP 10-year had 75 basis points, about almost a 15.5% move. It was, Japanese equities, down 1.25%. It's, that it's an interesting component there. Wow. Just since I have it, I'll share it, I guess, with folks. But that tail level on EWJ is down at, to round it off, around just under $60. So for those, and trends are right around 61. So that's kind of a crucial level for EWJ. They're right around 61, 60. 61 and then 60. Yeah, FXY. Yeah, it's or the yen. I mean, this could be an interesting new long, this could have legs. The yen. I mean, it was just such a bearish long cycle, full cycle, bearish trade or bearish trend for a long time. Now it's kind of reversing. This could be the beginning of something new. We'll see time and space, but I think if you allocate the position, size it appropriately, try to capture that full cycle, it's very possible you're seeing something new develop there in Japan. And you got to remember too, right? X2, it's like the Japanese yen is a flight to safety trade, which if things do really get squirrely, you can see capital flowing into the yen even more.
Yeah, well, I think that this is more of a interest rate regime change potential.
Yeah,
that's the driving force.
Yeah, no, 100%.
But anyway, I just wanted to call that out.
Yeah, totally, dude. Yeah, good job.
Thanks a lot for doing this.
Yeah, absolutely. All right, any other questions, comments out there? UK, Kospi, covered India, DAX is bullish trend, but Germany's GDP looks awful. All right, George coming up. Cool. Hey, George.
Hey, brother. How are you doing?
Good, man.
I came in a little late. Did you guys talk about the yield curve at all?
A little bit. We didn't totally dive into the yield curve, but we talked about the move and 10-year tail support, that kind of thing. But yeah, go ahead.
Yeah, I was just going to say I'm getting interested in, steepening. Because we started, earlier this year, we had peak inversion, steepened a little bit, reinverted, and we had that big steepening into mid-October. And we've given a lot back, and I think the path forward is steeper, not further inversion, as the likelihood of recession, the onset of recession approaches. So that's something that, is on my notebook today. Call outs.
Yeah, absolutely. But when do you need the 2-year to fall?
Well, it just depends on which one goes down or up quicker. Right?
Yeah.
That's true. So if the 2-year only, but if it goes up a little bit, but the long end goes up more, in the short term, you get steeper. And, but yeah, of course, obviously, you're going to need actual cuts, most likely to get you completely uninverted.
Yeah, okay. Yeah, that's kind of what I was thinking about. Yeah, okay. Yeah, no, yeah. It's makes sense. I mean, I think the good way of expressing that for those that is eyeball, right? That's I don't know if you have that on the book yet, but IBOL.
Yeah, I just try not to mention products specifically.
I can.
I know you can.
Yeah. So that's eyeball again. I mean, the way that I think about that, it's not in Nancy Davis. I've had conversations with her. She does it much more eloquently in terms of how she leverages options and all that kind of stuff. But that eyeball is to me performs the best when you've got a steepening environment. So kind of keep that one. We're not long eyeball, so just keep that one in your back pocket. Put that on the radar, on the watch list. I think that'd be to your point, George, probably a prudent move to do. My
It's just where you put it on. I mean,
yeah,
I think following Keith's kind of process, you're gonna wait for the trend change.
Yeah, exactly. I mean, I think in this, like if the 10-year and the longer end of the curve continues to price in recession risk rising, then likely those rates continue to move lower, and we break down through that 4% tail level on the 10-year, and then the question becomes, okay, does the Fed cut? And with our nowcast or estimate of basically 3.25% on the inflationary side, it'll be hard for them to justify a cut.
Yeah.
Right. So it's going to be interesting. I think.
Yeah, I'm sure our notebooks look similar with regards to rates being at extremes on the ranges.
Yes, exactly.
So the other thing I was looking at is our favorite interest rate hedge. Again, being a bad boy here with bearish trends and all, but things don't happen in a straight line. We've priced in a lot really quickly.
Yeah, exactly. We have, 100%, right? I think I mentioned it earlier. I don't know 4.10 is where it closed yesterday. That was or just above that, and we low into the risk range, and we popped from there a hair. But it was a question that we got a lot last week, George, in Toronto. Was how do you think? Basically the question was around like, how do you think TLT is it time to get long TLT? What's the deal with treasuries and interest rates and stuff like that? And it's still early days, right? Like the signal hasn't quite confirmed the, as I said, that tail. You're really, for this new regime to kind of or this pivot to occur in terms of to really give you green lights, you really need that tail level to break. So right now it's support. You basically kind of need that to turn into resistance, and it hasn't.
Yeah, you need a higher low.
Yeah, exactly.
Yeah. It's you need a higher low. I've got exposure to that stuff, but I took my interest rate hedge off. It was like the first week of November when things started to turn. So it's been fun riding the duration train after it clobbered so many of us for like 2 years, right? And but I don't forget, and that's why I'm right back to that hedge. Put that on today.
Yeah.
Because everything's just so extreme, and you got Mr. J. Powell talking to us next week, and he could very easily just calm everyone down and say what we think he's going to say, which is, we have to get a couple data points at 2% in order to even consider the first cut. So people have gone really far really quickly. So I don't know.
Yeah,
totally. You gotta give back. It doesn't mean we have to reverse the current trends completely, but there's a lot of stuff that's shifting right now.
No, totally. And I think from a risk management or portfolio construction standpoint, you can have some inflationary exposures on the other side of that, right? So just as a bit of a hedge or kind of a what have you, things that continue to look good, like uranium looks great. Gold obviously functions well in that similar environment. GXG, so Colombia, from that, I know that's more equities, but it's certainly has kind of an inflationary, or has commodities exposure there. Even something like a wood, right, like a WOD, that signal's picking up, has some very good signal strength to it as well. So yes, I mean, I think you can Bitcoin as well, right? Like you got GLD BITO exposure opposite your, say, to your point, your duration exposure. It can kind of be a bit of a hedge inside the portfolio.
Yeah, you know me, I like to do the seesaw.
Totally. One goes
It's time to right now I'm pushing on the other end of the seesaw.
I love it.
The other end's up in the air. It's freaking me out.
Yeah, no, 100%. Anything else in the book?
Energy is a little interesting, not yet, but maybe soon. But that would be on a super short leash because if growth and demand slow down enough, that thing's going to tank. But if it doesn't go down enough, it could rear its ugly head again. So,
yeah, I agree with you there. I think it's going to be interesting to see how the market, reacts to slowing growth. But as I mentioned at the beginning of the call, kind of a GDP number in Q1 being around 160 basis points, right, and coming down from about 245 basis points or 246 in Q4. So yeah, it's a big rate of change decline of about 100 basis points or 90 basis points to be specific. And how does that impact things, right? Does that continue to put sort of a blanket on, say, oil demand or energy demand, or is sort of a 1.5% growth number still good enough, right, George? Who knows?
Yeah,
I think time will tell.
Yeah, take it as it comes. That's what the data is for.
That's right.
Keep just thinking too much and telling ourselves narratives.
On the, I've turned into a bit of a stock junkie, and I've kind of measured like 1,500 stocks now, which is mental. But just on the kind of energy, like the flip side of energy, is that like some of the utilities are starting to perk up. Because obviously the flip side of energy prices going down is if you've locked in charging your customers when the price of natural gas was at $5 and the price of natural gas is now $2.50, but you've locked in their payment plan or whatever, then your margins are going to go up. So it's been interesting watching some of the utilities start to look a little bit interesting, but yeah.
Yeah, and there's even like divergence on the underlying inside of energy in terms of refineries versus things like an XOM. Like XOM and Chevron look like shit, and something like an MPC looks a lot better.
Yeah, they've started to give up. They held up. They had held up for the last few weeks. That there was a divergence to the rest of like the energy sector, but they have for the last like 2 or 3 days. They've started to give back, but yeah, like anything, like it's. I mean, if you take something like XLK has 73 or something, or at least there's 73 tech names in the S&P 500, and they're not all going to act the same. Now, at any given time, that doesn't mean that moving forward tech is going to be great. That's not what I'm saying. But when there's enough things within, like if you're looking at 73 different names, and then you have one ETF, which is XLK, there's going to be loads of divergence with inside it, which I never thought I was going to be talking about. But now I'm like, now I know tickers and everything of all these different all these US equity names that.
No, how the tables have turned, eh, Chris?
Yeah, exactly.
Yeah. No, it's good. It's interesting. Yeah, for sure. I appreciate you sharing those insights. All right, cool. We're coming up on an hour mark. I think, we've covered a lot of really high quality content here. So we'll, when we call it a day, call it an evening. Thank you everybody for joining in. we've got our kind of company meeting and holiday party on the Wednesday and Thursday next week. So I will do my best to do this on maybe we'll do a quick one on Monday or Tuesday night, Tuesday next week, maybe midday Tuesday actually. I got to look at my calendar, but I'll let everybody know. Give people ample warning in terms of when the next WNR will be. I appreciate everybody tuning in. I appreciate you guys, George, Chris, X2. Thanks for jumping up and sharing your thoughts and insights. Always a pleasure. And again, for anybody that was in Toronto last week, thank you for spending your time with us and coming out in person. We'll do more of those in 2024. So looking forward to getting to both international places, like ideally, fingers crossed, London, and then other places within the U.S. as well. So with that, we'll wrap things up. Thank you, everybody. Cheers.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.